it looks like China is now fighting back with the United States economy, this time by dumping the United States dollar. How do we know? Last week, the People's Bank of China, the central bank, put out a statement saying Chinese banks should withhold United States dollar purchases. At the same time, the government of China has also been working to sell off United States dollars as a way to weaken the United States economy and weaken the United States dollar. Now, to be fair, this isn't something that just started last week. The Chinese government has been doing this for a while because they've been working to distance themselves from the United States dollar, but it looks like it's been accelerating ever since tariffs started on China. Why? Because the tariffs on China would naturally hurt the Chinese economy because it would bring business out of China. Why does this matter? Because China is the second largest holder of United States dollars. More specifically, China is the second largest holder of United States debt, only after Japan. And if China holds a lot of this United States debt, they can sell off some of this debt, which could hurt the United States dollar and it could hurt the United States economy, but I'll explain what all that means and how it affects you in just a minute. The other thing that I want to talk about has to do with concerns about the United States economy because the Federal Reserve Bank just put out a new report where they said Americans are now bracing for the biggest jump in unemployment since the pandemic. There is now a 44% chance that unemployment in America is going to be higher in 12 months. In addition to that, the Federal Reserve Bank also now believes that inflation will be higher 12 months from now than today. The Fed says that they believe inflation will be at 3.6% in 12 months, whereas our last inflation report said inflation was at 2.4%. But some people in the Fed think it's even going to be worse. There is a Federal Reserve Bank governor named Chris Waller who recently gave an interview, and he said inflation could surge to, quote, near 5% in 2025, and economic growth could, quote, slow to a crawl if the effective tariff rate remains at 25%. Now, the Federal Reserve Bank did give a little bit of encouraging words because the Federal Reserve Bank say they, quote, would absolutely be prepared to stimulate markets if needed. What does that mean? That if needed, the Fed would be ready to cut interest rates to stimulate the stock market, and they would potentially even be interested in quantitative easing, money printing to stimulate the stock market as well. Now, they didn't say that outright, but it seems like that's what's implied when they say that they would, quote, be absolutely prepared to stimulate if needed. Now, let's explain what's going on. That way you understand how all this affects you, starting with China. I don't want to go over everything going on with tariffs because there's a lot happening, and my team at Market Briefs is breaking this down every single day. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy and tariffs and the global economy, stocks, housing, and crypto into a fun, witty, and easy to read newsletter. It's read by hundreds of thousands of investors every single day. And when you join Market Briefs, you'll also get access to a free investing masterclass. So if you have not joined Market Briefs yet, again, I have the link for you to join down in the description below. But all these tariffs are going on with China. There are some loopholes, there are some exemptions, and it's going to change every single day for as long as this goes on. But this is what's creating now a little bit of, I don't want to say economic warfare, but I can't come up with a better term. There's some economic fighting happening between China and the United States. And this is where we are seeing changes in our economy, more specifically with treasury yields. Now, this is going to get a little bit complicated, but let me break this down. Anybody can lend money to the United States government by buying what's called a treasury. A treasury is a loan to the United States. So you and I can loan money to the United States by buying a treasury, and foreign countries like China can lend money to the United States by buying these treasuries as well. And the interest rate that the United States government pays on these loans, these treasuries, is going to depend on supply and demand. When there's a lot of buyers for these treasuries, when a lot of people want to lend money to the United States government, the government offers lower interest rates because there's a lot of buyers. They don't need to incentivize you to lend money to them. When there's not a lot of buyers of these loans, or if a lot of people are selling off the United States debts, now the government needs to incentivize people to buy the United States debt by raising interest rates. And what we saw last week is that interest rates set by the United States government went up at the fastest rate that we have seen since 2001, more than 20 years ago. And the sharpest moves in the treasury market happened when the Asian financial markets were opened. Meaning, there's speculation here, but it seems like the Chinese government or Chinese holders of the United States debt have been dumping some of the United States dollar holdings as a way to potentially weaken the dollar or weaken the United States economy. Now you might say, well, how does them selling off this debt weaken the economy? Well, if the Chinese government is selling off this United States debt and our treasury yields go up, why does that matter? It matters because when treasury yields go up, your mortgage rate goes up, your credit card interest rate goes up, business loan interest rates go up, your car loan interest rates go up. Because banks look at the treasury yield that the government is paying out and they set their retail rates, so their mortgage rate, their credit card rate, their car loan rate, their business loan rates, based off of what treasury yields are. So when treasury yields go up, your retail rates go up as well. That's why this matters. And so there's been this change in treasury yields over the last week, the biggest jump that we've seen in more than 2 decades. A lot of people are saying it's because of China. And now it's been playing an impact in our economy because now it's impacting our interest rates. It's not just that. If you are on TikTok, chances are you have seen a new wave of ads from suppliers in China. And based off of the news, again, we don't know for sure, but based off of the news articles that I've read online, it looks like some of these suppliers say, or maybe they are, but they say that they are suppliers for companies like Lululemon and Nike and luxury handbag companies. And they're essentially saying, hey, because of these tariffs, why don't you just contact us, the supplier, directly and buy from us directly, and you won't believe the discounted price that we're going to give you because you can buy the same bag for a fraction of the price that you would have to get it from at the store. So instead of going to the luxury store, instead of going to Lululemon, instead of going to Nike, you can buy it directly from the supplier for 1/5 of the price, essentially. Which we don't know how true this is. We don't know what's going to come of it, but this has kind of just been an ongoing thing over the last week as well. And this is where it has also caught the eye of our Treasury Secretary. And what the Treasury Secretary of the United States government said is this, quote, if you take a bank loan, the bank is in charge. They can repossess whatever you borrowed against, but if you take a big enough loan, you're kind of in charge of the bank. What does that mean? Well, here, the bank is China. It's not the United States, because remember, China is the one who lent money to the United States. And this is where the Treasury Secretary is saying, well, normally, if China is the bank would be the one that's in charge. But if you take a big enough loan, here, in that case, that's the United States taking out a huge loan from China, well, now it's the borrower that's in charge of the bank. Because if you go to the bank and you take out such a big loan that if you defaulted on your loan, that the bank would be in trouble, you can start to see how that'd be a problem. And that's kind of what the Treasury Secretary is hinting, that, hey, China, if you mess around by selling off the debt, you could be the one in trouble because we are the person that might not pay back your interest. Now, again, that's not what he said, but it seems like there was a little bit of undertone of implying that. Not to mention, I know it's a lot of information in this video, but I'm going to say one more thing. We also got news that the People's Bank of China, again, their central bank, added gold to the reserves for a 5th straight month. Why? To potentially build up their own wealth or currency, hard money, whatever, because it seems like certain countries, including China, have been stacking gold as a way to potentially protect their economy against whatever. What does all this mean? Well, it depends on who you are. It depends on what your investing strategy is. We know that there's going to be a lot of economic back and forth. Maybe it will end with an amicable resolution. Maybe it will continue going on for a number of weeks or months, maybe years. At the end of the day, what you want to remember is you don't want to panic. These things happen. Over the last 100 years, the United States economy has been through a lot of changes, a lot of ups and a lot of downs. But the people that have built wealth were the ones that invested their money, bought assets, and found opportunities when there was a lot of craziness. Chances are there's going to be a lot of craziness happening over the next coming years because we're making a lot of changes in our economy. Tariffs are going to change the way our economy works, and they have been changing the way our economy works. And this is where it is so important for you to become an investor. That way you can find the opportunity instead of being the one that's just paying the price. So what does that mean? Number one, get smart with your money. If you are living paycheck to paycheck and you're spending all of your money, none of this matters. It doesn't matter. The only thing you got to worry about is how you're going to pay your bills right now and how you can save a little bit of extra money so you have money to invest. If you are living paycheck to paycheck, you're struggling with credit card debt, it doesn't matter what all this stuff is doing. You got to take care of your own house first. Once you get your finances in order, you stop spending all of your money, you have money to save, you have money to invest, now you can start being a little bit smarter with your investments. This is where now you got to get away from the emotion, because there's a lot of emotion out there. People are going to tell you that this is why you got to get out of the markets. This is why you got to buy. There's a lot of emotion. The media loves selling you emotion because that's how they get paid. You got to stay calm. Then number three, you got to have a strategy. You got to know the game that you're playing. A lot of people say that they want to be long-term investors, but then as soon as something bad happens, they panic and they sell and they become day traders. That's not how you build wealth. Wealth is built through long-term investing, not through emotional trading. Emotional trading makes Wall Street rich, and it does not make you rich. In fact, it keeps a lot of people broke, and it keeps a lot of people angry, and it keeps a lot of people hating the markets. When in reality, the way you win is by being a long-term investor who has a long-term vision. We're talking about years, if not a decade plus, or multiple decades. Now, once you start thinking like that, now you got to come up with the right plan for you. Do you want to be more of a passive investor, more of an active investor? A passive investor is somebody, in my view, who is just buying the broad economy. Now listen, I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. You will lose money at some point. Make sure you always do your own due diligence and never blindly trust a random guy on YouTube. All right? A passive investor, in my eyes, is somebody who is buying the broad economy. Maybe the S&P 500, that's a group of the 500 largest companies in the stock market. Maybe the total stock market, maybe the Dow Jones. You're buying a piece of the broad economy. There are funds that will give you exposure to all of that. And you set it and forget it. I call it ABB, always be buying. Now you set up a system and you just turn it on and you forget about it. Every week, every 2 weeks, every month, you just keep buying more, whether markets are up, whether markets are down, whether there's an economic trade war happening. No matter what's happening, you just keep buying, because that has been the proven way to build wealth slowly over the long term. The alternative is to be more of what I call an active investor, not a trader, an active investor where you're looking for more individual, more specific niche opportunities. You're looking for where the money is moving. You're looking for, there's this trade war happening with China and the United States. There's this economic fight happening. Who are the companies that are going to benefit? Where is the money going to move? And then you look for opportunities there. If that's something that you're interested in, great. Understand it takes more work, it takes more time, it takes more research, it takes just more energy to do so. It's not for everybody, but for the people that aren't interested in it, there are opportunities there for you as well. But what I would say for most people, the simplest way to get started is just to be a passive investor. But in order to do that, you got to have money to invest. And this is where you got to be able to cut through the noise and find the opportunity instead of being the person that just get caught up in all the emotion, because there's a lot of emotion out there. There's a lot of changes happening, and there's going to be a lot of changes. Who knows what's going to come out of it? But your job isn't to try to predict that. It's to be able to find the opportunity, because that's what's going to allow you to continue to take better care of yourself, continue to take better care of your family, and continue to take better care of your community, because nobody else is going to do that for you. Now again, if you want some additional resources, Market Briefs is a free newsletter. I have that for you down in the description. And when you join, you'll also get access to my free investing masterclass. And with that, I will see you on YouTube tomorrow.